This screencast is going to look at Autumn 13 question 3, so an issue question, and focus in particular on IAS 36 and IAS 19. So we're going to firstly look at question 3 issue 1. We've split into two issues here. The first one is to do with IAS 36. So you can always look at the requirement first just to get a sense of what's been asked. So calculate the extent of any impairment loss for both R-Tech and MIML. And then again, watch the use of the underlying here. There's a multiple requirement here. Show the necessary journal entries to reflect any impairment loss. So you do not forget you need to show journal entries to get the full requirements here, or to get the full marks. So I'm assuming you've read through the background of the question. If not, pause the screencast now and go back and read through the full question, particular issue 1 around the impairment. So we're told here that R-Tech and MIML are two products, and the manufacturer of the two products has declined in 2012, and because these low margin products were moved to lower cost countries. So you know both of them are what's called a CGU, and that's important for IAS 36, is that's a cash generating unit. So typically in IAS 36 impairment questions, you'll either be focused on an individual unit or an asset, or you'll be looking at them as a bundle of assets, and that's what's called a cash generating unit. So again, if that is new to you, you should go back and revise IAS 36 before attempting this question. So we're told here what the carrying value of both the CGUs are, R-Tech and MIML, plant and equipment, patents and goodwill. We're also told what the estimated selling prices are today at the end of December 2012 or at the end of 2017. And again, we'll need this for some of the calculations that we are going to use. And finally then we're told what cash flow projections are for the next 5 years, and we're given a weighted average cost of capital. So the typical approach to IAS 36, and just by way of a brief recap, is if there is an impairment, you need to compare the carrying value. So the carrying value is compared to what's called the recoverable amount. So you compare both of them, and the general rule is if the carrying value is bigger than the recoverable amount, then you're going to have an impairment. And think about it logically. If what you have in the books is bigger than what you can recover from those assets, then it's overstated and it should be impaired. You should bring it down to what the recoverable amount is. However, if the carrying value is less than the recoverable amount, then there is no impairment and you've no adjustments to be made. So you compare the carrying value to the recoverable amount. Now there is an additional step before you get to there is, well, what is this figure? So if we just draw a line down, the recoverable amount is made up of two things that you have to compare. It is the higher of the fair value less cost to sell. So that is, what is the fair value of the asset today less the cost of selling it, or so the higher of that, or what's called the value in use. And that is essentially like an NPV or discounted cash flow. You get the future cash flows off the cash generating unit and you discount them back at an appropriate cost of capital. So that is important. Now typically you may do it for an individual asset, but you can also do the same thing for a cash generating unit. There's only an additional complexity at the very end in terms of how you allocate an impairment if you are doing it for a CGU. So there's two key steps. Step 1 is get the higher of the fair value less cost to sell and the value in use, and then that will become your recoverable amount. So if you even want to do this the other way, so the higher of them becomes your recoverable amount, and then you compare that to your carrying value to discuss or to determine whether there's an impairment or not. So if we do that for R-Tech and MIML, so let's firstly look at the carrying value. We'll just call this ART and we call this MIM. The carrying value here is all the assets, because it's a unit, is 675, and the carrying value for MIML is 800. So that's our first step done. We can also fairly quickly also get the fair value less cost to sell, because we're told in the question the selling prices of plant and equipment at the year end were 650 and also 900. Therefore we can use those because we're told the intangible assets cannot be sold, and of course goodwill cannot be sold separately. That will be the fair value less cost to sell, will be 650 plus 900. So the only final thing we need to calculate now is what's called the value in use. And to get the value in use, so we leave a VIU there, we come down here and we need to discount the future cash flows. So for the next 5 years using the 12%. So for Artec, we'll call it cash flow 1, 2, 3, 4, and 5. Cash flow year 1 is 240, 200, 150, 120, and 90. And the cash flows for MIML will be 390, 350, 310, 280, and 200, all given to you in the question. Now the one thing to watch for here is, well, if I am selling the cash generating unit at the very end, then I will also add in the selling price at the end of 2017. So that is why you're told in the question is, if I'm going to use this for the next 5 years, it will also have a residual value. So the residual value you're told for Artec will be 40, so you add that to the year 5 cash flows. And likewise the residual value for MIML will be 60, which again you'll add to the year 5 cash flows. So what we're going to do now is we're going to get the present value of each of these using 12%. So I'm just going to do it on the right hand column for each. So we'll call here present value and present value. So again, this is getting back to your basic finance 101. It's the future value, which is the cash flow in 1 year, over 1 plus 12% to the power of the number of years, which in this case is 1. So the present value of all of them, and you can repeat that, and I'll just tidy this up. So you can repeat that for each. So the present value, for example, in year 4 will be the year 4 cash flow over 1.12 to the power of 4. And if we add those up, giving the present value of all the future cash flows is 630.5. So we'll use that as a value in use, and we'll put that up there as we'll call it 631 to round. So we can now compare these two to figure out what the recoverable amount is. Exact same approach then for MIML. We take each cash flow and discount it by the number of years to get its present value. So you can go back and double check you're comfortable with those calculations. So there is a bit of corporate finance here and time value of money. And we get the value here to be about 1,173 or 1.17 million because we're working in millions. So that is how you get the value in use. You discount the future cash flows, including any residual amount at the last year, using the appropriate cost of capital. In this case, it's 12%. Alright, and again, there are specific guidelines in terms of what cash flows you take. They should be pre-tax and pre-interest, and what discount rate you should take as well. And they are in IAS 36, which you can get in your IFRS book. So we now have what we need in terms of the 3 different sources of information. We first need to figure out, well, what is our recoverable amount? The recoverable amount, which we can bring down here, so the recoverable amount for Artec will be the higher of its value in use and its fair value less cost to sell. Therefore, in this case, the recoverable amount will be 650. So it's the higher of the two. Likewise, for MIML, it'll actually be the value in use, 1173, because again, you're taking the higher of the two. Now we compare that to the carrying value, which in this case is 675 and 800. And we ask then, do we have impaired? So is it impaired or not? And the question is then, the rule is, it's only impaired if the carrying value is worth more than the recoverable amount. The carrying value here is worth more than the recoverable amount, therefore yes, it'll be an impairment of 25. In MIML's case, the recoverable amount is bigger than carrying value, so carrying value is smaller, therefore no impairment, and therefore no adjustment required. So nothing to do with impairment because we don't have an impairment situation. So now that we've identified whether there's an impairment and how much it is, don't forget you have to prepare the journal entries to reflect any impairment loss. So we do have an impairment loss for Artec. And this is where a bit more complex comes in, because it's no longer as simple as writing debit impairments, P&L, credit property, plant and equipment. Because we're impairing a cash generating unit, we need to have some rule to say, well, which asset do we impair? Is it the goodwill, the patents, or plant and equipment? And if you want to recap on these rules, look at paragraph 104 and paragraph 105 of IAS 36. The general rule is, firstly, you reduce the goodwill, if there is such, in the cash generating unit. Once all the goodwill is removed or impaired, you then allocate pro rata to the remaining assets. So goodwill first, then pro rata to the remaining assets. And again, if you want to recap where that's coming from, it's IAS 36, paragraph 104, paragraph 105. So in our case, for Artec, it's all going to be written off. The 25 is coming off goodwill. So the simple debit and credit will be debit P&L, impairment loss, 25, credit goodwill, 25. And again, remember, you are asked for the necessary journal entry, so don't forget to put it in because there will be marks going for it. So that is IAS 36, impairment of a cash generating unit. And if you do want further practice in terms of past exam questions in that area, look at Summer 15 question 3. So that's Summer 15 question 3 and Autumn 14 question 1. So it has come up in the past couple of years as well, in Summer 15 question 3 and Autumn 14 question 1. So the next part of this question then will be around IAS 19, particularly dealing with pension schemes, a defined benefit and a defined contribution pension scheme. So typically defined benefit schemes are very much a troublesome area for students, so we're going to look at an approach to tackling the defined benefit pension scheme. So you're asked two parts here for 13 marks. Prepare all the relevant journal entries, firstly, and correct the above transactions. So you want journal entries and correct the above transactions, and prepare the relevant extracts from the SPLOCI, Statement of Profit, Loss, Other Comprehensive Income, and the SOFP for the year end 2012. So the first thing we're going to work at is we're going to start by doing all the relevant journal entries to record the defined benefit scheme and the defined contribution scheme for the period. Now again, read down through the question, pause it now and read down through it to make sure you're comfortable with all the information given. So we're told in the question, in respect of both pension schemes, Grant only made the following journal entry. So they debited pension cost in the P&L, 285, and they credited bank. And this was for the pension cost reflects all the contributions made during 2012. So again, it's useful just to get the lay of the land in terms of what is made up in that 285. So we're told it's made up of all contributions. So it must be made up of the 140 from the DB scheme. It must also be made up of 55 from the DC scheme, from the employer, so call it ER, and it must also be made up of 90 from the DC scheme from the employee. So that's important to understand. Well, that's what the 285 is made up of. So always in any type of financial reporting question, try and make sense of the information given. So they debited pension costs P&L 285, credited bank. Now we know under your knowledge of IAS 19 that you do not put contributions, particularly for the DB scheme and also for employees in the defined contribution scheme, they do not go to the P&L. There's different elements that go to the P&L. So I think the easiest way to start is, and probably the easiest way for a lot of things, is to just reverse that transaction. So credit, P&L, pension cost 285, and debit bank 285. So I think the easiest way is to reverse it out, and we'll then do from scratch all the journaling entries that are required. Because we know here contributions are not necessarily going to the P&L. There will be other elements that go to the P&L, and we'll see that as we go along. One of the easiest ways to do a defined benefit question is typically to do a table, and you will see a lot of the suggested solutions will take this tabular approach as well, and it makes it a lot easier to follow all the items. So we typically set up a table with assets as one column, liability as another column, P&L as one column, OCI, and then also the SOFP. This just allows you to track where the impact will be as you go down through each of the movements. So we first look at the opening balance at the start of the year. You had a pension asset of 690 and you had a pension obligation or liability of 785. Meaning your opening position, which is net in your balance sheet, would have been 690 minus 785, i.e. having a liability of 95. So that would have been your opening position at the start of the year. And now we want to figure out what are the movements made during the year. So if we look at here, we have a number of different movements that we have to capture. So there was no journal entry for the initial one because that would have already been there, sitting in your balance sheet at the 1st of the 1st, 2012. The first one is service costs. And again, if you don't know what these mean, it's important to go back and revise the IAS 19 chapter to understand what each of them are. Service costs are not a cash cost, but they are the cost incurred for an extra year's service for your employees. So the value of the pension entitlements earned by employees over the year. And in that case, they will increase your pension liability because they've earned more pension entitlements because they've worked during the year, and it will also be written after the P&L. So just we'll put in here 1, and we'll come down to do our journal entries. Let's put this better. We'll come down and do a journal entry for 1. It will be debit P&L, credit pension liability. So that's the service cost for the year, debit 90, credit pension liability 90. So what initially would have been done about debiting the 140 as contributions was not correct. You only debit the service costs, i.e. the actual cost incurred during the year, which may not necessarily be the amount paid. So that's the first, is increase your liability and write it to the P&L. The next one are benefits paid. These are essentially benefits that are paid to pension holders during the period. So they will reduce your asset because you're paying it out of your asset plan, and they will also reduce your liability because you've now paid off some of your obligation. So you only have to make 2 entries, and that's what it does, minus 75, minus 75. So the nice thing about pensions, once you do practice them, is it's very similar time after time in terms of the approach to the question. So the debits and credits here will be debit pension liability, credit pension asset, and both are 75, 75. Okay, so that's fairly straightforward again, and again you're gradually building them up as you go down along. The next one are contributions paid. In this case, you're paying contributions into the scheme, therefore you're going to increase the assets by 140. It doesn't go to the P&L, where it goes is to bank. So you can put it here as a 140, so minus 140, and you can put it to the bank if you want to track that. That the bank is going to get your increased pension asset by 140 and your credit bank. So you don't actually debit, as they've done up here, the P&L. That's not where the 140 goes. It goes to debit in the pension asset. So because we've reversed out the full 285 before, we can just make in the correct original entry, which would have been debit pension asset, credit bank for contributions paid, which would have been 140 and 140. Because we reversed it out, we don't need to do a net adjustment, as you might see in the suggested solution. We can just do it from what it would have been correctly from starting from scratch. The other thing to watch out for here that you need to be aware of is you have to recognize interest on the asset and interest on the liability during the period. And you'll typically be given a rate. They may be separate rates, or you may be just given one rate. So we'll do interest here. So it's always on the opening amount, so you will have 690 times 9% interest income, because again you're getting interest on the assets that you have, the pension assets, but you also have a negative or liability which will increase by 0.09 as well. So your interest income will be about 62, but your interest expense, because you're increasing the liability, will be 71, meaning the net position is a interest expense of 9, and that's what typically goes to the P&L, is the net interest expense and finance costs of 9. So again, we'll just show how that shows up. So you can show it separately, you can show it net. We'll just show it separately. It will be debit finance costs in the P&L, 9. We will be debiting pension asset. In this case, we will be increasing the pension asset by 62, because that's the interest income earned. And we will be crediting the pension liability, 71. So that makes it balancing, and we have a net cost to the P&L of 9. So incorrect as one before, we need to You don't bring the contributions to the P&L for pension, defined benefit pension. You bring the service costs and the net interest cost. So adding up them, all the movements for the year, that gets us to, we expect the asset to be 817 at the end of the year, and we expect the liability to be 870 at the end of the year. So that's what we'd have expected to be our 871 at the end of the year based on all our movements. However, we know the closing balances from the actuarial or the actuary's report tell us that the fair value of the plan assets is 780 and the fair value of the obligation is 880. So that tells us that we know the closing balance in the pension in the SOFP will be minus 100, a net liability of 100 in non-current liabilities. But that doesn't reconcile to the movements that we've done so far. And this is another tricky element that students struggle with in IAS 19 is you will have what's called actuarial measurement gains or losses. And those go through the OCI. That is why we have that here. So when you have done all the movements, when the actuary comes back with their fair value at the end of the year for both the pension assets and the pension liabilities, there will be some movement due to actuarial valuations, and those movements go through the OCI. So we'll see here, we expected it to be valued at 817, it's now gone down to 780, therefore the value must be, or the actuarial loss must be 37. So we'll call that actuarial loss. So the asset has reduced by 37 based on the actual report at the end of the year. Likewise for the liability has actually gone up by 9. So while they're two separate different signs, they both mean the same thing. It's also an actuarial loss. So let's put this down here actually. That's also an actuarial loss because you're increasing the asset, or increasing the liability should I say, and decreasing the asset. So both of these have the net effect of being a loss to the OCI, minus 37, minus 9, because you are decreasing an asset and increasing a liability. So that is one thing that students do struggle with, is the concept of the element of an actuarial remeasurement gain or loss, and the fact it is separate, it goes through the OCI. So how would we do that? How would that show up in terms of debits and credits? Well, let's come down here and we'll do 5. So let's put 5 up here as well. Do 5 together. We would credit pension asset because we're reducing it by 37. We would credit pension liability because again we're increasing the pension liability by 9. And then we would debit OCI by 46. So both of the net impact of being losses overall, because they're negative impact, it's increasing a liability and decreasing an asset. So the overall position is then we have a debit to the OCI of 46. And that is how you would do the defined benefit scheme, of tracking it through and then making sure you have the correct debit or debits and credits or journal entries. Because it is a favourite of the examiner to ask the debits and credits in terms of a defined benefit scheme. The other thing we have here is defined contribution scheme. So this is where the employer does not promise a secure benefit at the end of the retirement or at the end of the your employment when you retire. They only give you a defined contribution, and after that the risk is on your pension yourself in terms of what growth it has and what return it earns. And a defined contribution is a lot more straightforward. The only journal entries you make are for your own employer contributions. So in this case the employer contributed 55, so it would be to debit pension costs in the P&L and credit bank. So that would be 55 and 55. So that was correctly accounted for before. It was in the 55, but the employee ones should have nothing to do with the firm, nor have they nothing to do with having assets on the balance sheet. Defined contribution, the employees will contribute themselves. They do not come through the books of the firm. The only ones that you want to capture are employer contributions, debit the P&L 55, credit bank 55. Alright, so that gets you all the relevant journal entries in terms of the first part for 8 marks. And the next part then asks you give the relevant extracts from the statement of profit and loss, other comprehensive income, and also from the statement of financial position. And you have three main extracts. You have a pension cost in the P&L, and that amount will not be the 285 that you had before. It will be 55 plus 90. So it will be 145 in terms of pension costs. And then you will also have finance costs, or you may put it in this line item as well, depending on how you present it, of 9. So the total there would have been 154 relevant to the pension costs, i.e. here, here, and here. And you can see how we track that, the 99 there, and also the 55 from the defined contribution scheme. So that is in the SPLOCI, so statement of profit and loss, other comprehensive income. You also have the OCI. You will have a remeasurement loss of 46. So that will be in the other comprehensive income section of the SPLOCI, a remeasurement loss of 46 due to the actuarial revaluation. And the final one then in the SOFP, you'll have a non-current liability, and all it is very simple. It is the assets at the end of the year, the updated actuarial report, minus the liabilities, giving me a net position of 100. So it's moved from an opening net position of a liability of 95 up to a liability non-current of 100. And again, that is the IAS 19 defined benefit scheme and the defined contribution pension scheme. As I said, it's typically one that students do struggle with. However, there has been numerous past exam questions, particularly in the last couple of years, that you can now practice on. So Summer 13 question 1, Summer 14 question 1, and Summer 15 question 1, all the compulsory case study have all had a IAS 19 pension related adjustment. So again, go back and look at Summer 13, Summer 14 and Summer 15 case studies for practice questions around this. And you'll notice there's a lot of repetition, and once you are comfortable with the accounting and particularly the double entry, they will become second nature with plenty of practice. Another question, just to wrap it up then, is Autumn 15 question 4. So it came up in an issue question, also had IAS 19. So plenty of past questions to practice on dealing with defined benefit and defined contribution pension schemes.